Hello everyone, welcome to lecture number 28 of Swayam BHU course on Fundamentals of Economics and Financial Markets. Myself Dr. Anand Singh, and in this video I will be discussing with all of you regarding SEBI guidelines on public issues. Now in this particular video I will be discussing with all of you on four major key points. Those key points are: point number 1, what are the different kinds of issues? That means whenever a company decides to float its securities in the market, then what are the different methods of issues, or what are the different methods of flotation of issues, or what are the different methods through which the companies may float its securities in the market. We will discuss in detail about all these methods in point number 1. Now the key point number 2, here we will discuss regarding what is the meaning of public issues. Then key point number 3, in the point number 3, we will discuss regarding the SEBI guidelines for unlisted companies. Basically, there are two kinds of companies on the basis of listing. One, companies are regarded as unlisted companies. That means those companies have not been listed over any stock market. They are more or less new companies for the stock markets. They might be operating in the ground, but since they are not listed, that's why they are known as unlisted. So what are the SEBI guidelines for unlisted companies will be discussed in detail in point number 3. In SEBI guidelines related to unlisted companies, basically there are two entry norms, entry number 1 and entry norm 2. Entry norm 1 is basically known as profitability route, and entry norm 2 is basically known as QIB route, that is qualified institutional buyers route. So we will be discussing regarding both the norms, that is entry norm 1 and entry norm 2 in segment number 3. Now in the last segment of this particular video, we will be discussing regarding the SEBI guidelines for listed companies. That means those companies which are already listed over the stock markets, they are listed over any of the stock markets. Now they have decided to float their securities in the market. Then such companies, or what are the guidelines which must be fulfilled by such kind of companies? Again, there are two norms under listed category, that is entry norm 1 and entry norm 2. Now entry norm 1 is also known as here profitability route, and entry norm 2 is also known as QIB route, that is qualified institutional buyers route. Now let us discuss in detail about all these four key points in detail. Now the key point 1, what are the different methods of issues, or what are the different methods by which or by adopting which the companies may float their securities in the primary market. As such, there are four popular methods. Now, what are those methods? Number 1, method of public issues. That means by adopting public issues, the companies can float its securities in the market. Second method is rights issue. Third one is private placement, and fourth one is bonus issue. Now, let us discuss about all these things. First one is public issue, which I had to discuss in detail in the later slides of this particular video. So we are skipping this particular point at this point of time. Second point is rights issues. What is the meaning of right issue? Rights issues are basically those kind of issues which are offered by the company to their existing shareholders. Now it is important to discuss here why the company is basically offering its securities to its existing shareholder, so that the existing shareholder may maintain their shareholdings in the company itself. So in order to maintain their shareholdings, basically an opportunity is given by the companies to the existing shareholders, and so such securities are offered to the existing shareholders itself, and these form of shares are known as rights issues. Now the third important category is private placements. Now private placements are such kind of offers or issues which are made by the company to a list of sophisticated investors. Now basically a list is prepared under which name of some investors is written, and those investors are basically known as sophisticated investors. Now how list is prepared, who are basically the sophisticated investors, we will discuss in detail about such kind of things in my next videos. Now the fourth type of issue is bonus issues. Basically bonus issues are those issues which are made by the company out of their profits, or which are given by the company from their profits or from their reserves in the form of shares. That means the company is basically allocating such kind of issues or shares from the profit or from the reserve itself in the form of shares. Such kind of shares are known as bonus shares. But since such kind of shares are given from the profit itself or from the reserves of the company itself, so in absolute term or in real terms, bonus issues do not generate fresh capital for the company. Now, since bonus issues do not generate any kind of fresh capital for the company, that's why out of all these four methods, this method, that means the method of bonus issues, is basically eliminated. So only three issues are considered when we discuss regarding what are the methods of flotation of securities by which the company basically raise fresh capital from the market. So actually there are only three methods, that is method of public issue, method of rights issues, and method of private placements. Bonus issues are basically not considered here because although it is an issue, but since it is not generating any kind of fresh capital for the company, it is already given from the profits or it is already distributed from the reserves itself. That's why only three methods are considered under the methods of flotation of new securities. Now let us discuss about the method of public issue. First, we will discuss regarding the meaning. What is the meaning of public issues? Public issues are basically those issues which are offered by the company and the company invites directly the general public to subscribe its securities. Now, under this particular method, the company makes an issue inviting the general public to directly subscribe the shares of the company itself. Such kind of flotation is known as public issues. Now, public issues are basically offered with the help of offer documents. That means it is mandatory for the company to prepare offer document while making public issues. Now, offer documents are basically kind of written things or written matters. All the material contents regarding the company is clearly written in the offer documents. In case of public offers or in case of public issues, the offer document which is prepared by the company is known as prospectus. Now, the offer document which is prepared by the company in case of rights issue, that is basically known as rights to offer or letter for offer. That offer document in rights issue is basically known as letter of offer. So, offer document is prepared or it is compulsory for the company to draft an offer document before going for public issues. Now, why such offers are made? That means why a company basically makes public offerings. Such offerings or public offerings are basically made by the companies to invite the new shareholders so that the new investors may subscribe the securities of the company and they will become the member of the companies. That means after subscription, they will be regarded as the shareholders of the company and they will become the new shareholders or new members of the company. So public offerings are basically offered to the new investors so that the new investors might become the shareholders of the company. Now, whenever a company decides to make public offerings, then there are two different ways or there are two types of public offerings. Those two types or the two popular types of public offerings are IPOs and number two is FPOs. Now, let us discuss in detail about IPOs and FPOs. IPOs basically stands for initial public offerings and IPOs are basically offered by the unlisted companies. Unlisted company means those companies are not listed over any stock market. Here we are not saying that all these companies are completely new. No, unlisted company might be an old company, it might be existing company, it might be working in the field. But since those companies have not listed themselves or their securities over any stock market, that's why those securities are kind of new securities or new companies for the stock markets. So unlisted companies or comparatively new companies for the stock markets, they offer IPOs because they are completely new companies, they are unlisted. So whenever they will issue or float their securities in the market, they will float the securities for the first time. That means they will initially offer the securities in the market. So such fresh securities or such new securities which are issued initially, they are regarded as IPOs. Now FPOs. FPO basically stands for further public offerings, or it is also known as follow-on public offerings. Now, FPOs are basically floated by the listed companies. That means those companies which are already listed over the stock markets. They might be listed over one stock market or more than one stock market. But here the fact is, the companies which are floating FPOs, they are already listed over the stock market. But it doesn't mean that FPOs are old securities. No, FPOs are also fresh securities. FPOs are also new securities. But since they are offered second time, or follow-on securities are basically offered by the listed companies, that's why those new securities or fresh securities are known as FPOs, or follow-on public offerings, the or it is basically done by the listed companies. Now let us discuss about some other facts which are concerned with the public issues. Which type of companies are permitted to make public issues, or what are the major guidelines, or what are the major things which must be considered, which must be looked after by the companies if they are deciding to go for public issues. Now, some of the important points are: point number one, the company must prepare an offer document before it is offering the public issues. That means it is compulsory for the company to draft a prospectus or to draft a offer document. As I had already said, that offer document which is made in the case of public issue is known as basically prospectus. What is prospectus or what is offer document? It is basically a written document which contains all the material contents regarding the company. That means all the necessary disclosure must be made by the company in the prospectus itself. So one of the most important thing is the company must draft a prospectus, or it must draft a offer document. Now, who is going to draft this prospectus, or who is going to draft this offer document in case of public issues? Now, according to SEBI, as per the SEBI guidelines, it is mandatory that the drafting of offer document or drafting of prospectus must be done by a category 1 merchant banker. Now, the category 1 merchant banker, they are basically registered with SEBI. As such, merchant bankers falls into 4 important categories: category 1, category 2, category 3 and category 4. But only category 1 merchant bankers are eligible. They are permitted by SEBI to draft a prospectus or to handle the matters related to issue management. The category 2, category 3 and category 4 merchant bankers, they are not permitted to handle the matters related to offer document or the matters related to drafting of prospectus. So it is compulsory for the company to appoint a category 1 merchant banker who is basically going to offer public issues in the market. Now, in case of public issues, offer documents are called as prospectus. It has already been stated by me. Now, in case of rights issue, the offer documents are called as the letter of offer. Finally, in case of book building, basically there are 2 important methods. I will discuss in detail about those 2 methods: fixed price method and book building method. But suppose a company has adopted book building method in its public issues, then in case of book building method, the category 1 merchant banker will be regarded as BRLM, that is book runner lead manager, and the BRLM will prepare an offer document, and that offer document will known as red herring prospectus. That means the offer document in case of book building method, that means if the company has adopted book building method in order to determine the prices of its securities while offering the public issues, then in that case the offer document will be known as red herring prospectus. So red herring prospectus will be prepared and displayed by the merchant banker on behalf of the company. Now, there are certain important points also which a company must have to fulfill before floating its public issues in the market. Let us discuss about those points. Now, the prospectus must be drafted by merchant banker, and the prospectus must be advertised in at least 2 leading newspapers. Now, the advertisements is mandatory in case of public issues. That means if a company is going for public issues, then it is compulsory to advertise the matters related with the public issues in at least 2 leading newspapers. Now let us understand what is the meaning of leading newspapers. Leading newspapers are basically those newspapers the circulation of which is in at least two or more than two states. All of us knows that India is a very big country. It is divided into large number of states and union territories. Now advertisement must be done in leading newspapers. That means those newspapers which are basically circulated in two or more than two states or union territories. In the same manner, it is advised by SEBI that advertisement must be made in one Hindi newspaper, one Hindi leading newspaper, and one English leading newspaper. So advertisement in case of public issue is compulsory or mandatory in nature. That means if a company is going for public issues, then it is compulsory for the company to advertise such kind of things. Now, what regarding the offer period? In case of public issues, basically two methods may be adopted, fixed price or book building method. Suppose if a company has adopted fixed price method, then the offer period for public issues, the minimum number of days for which the fixed price method will be open, that is 3 days, and maximum days is 7 days. That means in case of fixed price method, the period or the offer period will ranges between 3 days to 10 days. And in case of book building method, suppose a company has adopted book building method, then the offer period ranges between 3 to 7 days. That means minimum days should be 3 and maximum days should be 7. However, there is one condition in case of book building method, that suppose the shares are not subscribed by the investors within the period of 3 to 7 days. Then in that particular case, an opportunity is given by SEBI and 3 additional days might be given to such kind of companies. That means besides 7 days, 3 additional days. That means in that condition, the maximum days will be 10. It will be given by the company to, it will be given by SEBI to the company. But in that condition, it will be compulsory for the company to revise its price base. That means earlier, whatever earlier price range was there, it is compulsory for the company to revise its price base. Then only 3 additional days will be provided by SEBI to that company. That means in case of book building method, as such, the offer period ranges between 3 to 7 days. However, there is an opportunity in the case if the shares are not subscribed, then 3 additional days may be granted by SEBI to such kind of companies. Now let us discuss regarding the SEBI norms for unlisted companies. That means those companies which are not listed over the stock market and they have decided to float their securities in the market. Basically, there are two norms, two entry norms. Now, every company, every unlisted company, it is supposed to fulfill all the guidelines which are prescribed under any of the entry norm. As such, there are two entry norms. Now, suppose a company, an unlisted company has decided to float its securities in the market, float its public issues in the market, then it has to fulfill all the norms which are either mentioned in entry norm 1 or entry norm 2. That means any one of the entry norm has to be adopted and all the conditions mentioned under that specific entry norm has to be fulfilled by the company. Now let us discuss about the conditions which are mentioned under entry norm 1 of unlisted company. That means what are the SEBI guidelines for unlisted companies under entry norm 1. This entry norm 1 is popularly known as profitability road. Now the important guidelines of SEBI under unlisted or for unlisted companies are: point number 1, the net worth issue of the company should not be less than rupees 1 crore for the last 3 continuous period. That means the minimum amount of net worth capital of the company should be at least 1 crore. That means 1 crore or more than 1 crore continuously for the last 3 annual year. Now, the entry norm 2 or the condition number 2 in this entry norm, that is the net tangible assets of the company should not be less than rupees 3 crore rupees in the last 3 preceding years. That means the minimum amount of net tangible assets of the company should be rupees 3 crore during the last 3 years period. It should not be less than 3 crore. Now, the next entry norm or the next condition under entry norm 1 is the company must have earned an average operating profit. That means pre-tax operating profit of rupees 15 crore during last any 3 years of the last 5 years period. That means out of the last 5 years period, in any 3 years, the company must have earned pre-tax average operating profit of 15 crore or more than 15 crore. Now, the next condition is, suppose the company has changed its name within a period of 1 year. Suppose any company is unlisted and it is willing to offer the public issues. Now, in that condition, suppose during last 1 year period, if the company has changed its name, then during last 1 year period, minimum 50% of the revenue must have been earned by the company from its latest name. That means from its changed name. That means, I am again repeating this particular point. Suppose the company has changed its name during the last 1 year period, then it is compulsory for the company that the company must have earned at least 50% of its revenue from the latest name. So it is one of the important SEBI guideline. Now next guideline is regarding promoters contribution. Now according to SEBI guideline under this entry norm 1, the minimum promoters contribution should not be less than 20% of the post issue net worth size of the company. Now what is post issue net worth size? Let us discuss this particular point with an example. Suppose the pre-issue net worth size of a company was say 4 crore rupees. Now the company, suppose it has decided to offer public issues and collect 2 crore rupees from the market. So its pre-issue net worth size was rupees 4 crore and the company is basically offering public issues for 2 crore rupees. Now suppose 100% subscription is there. So what will be the post issue net worth size? It will be rupees 6 crore, because initially it was 4 plus 2 additional crores which was raised by the company. That means post issue net worth size will be 6 crore. Now as per this particular guideline, the minimum promoter contribution is 20% of the post issue net worth size. That means 6 crore into 20%, that is 1 crore 20 lakh rupees. That means the promoter's contribution should not be less than 1 crore 20 lakh rupees in this particular condition. Now, the next condition is also regarding promoter's contribution regarding lock-in period. That means what about freezing of the shares of the promoter's contribution? So, the promoter's contribution was a minimum of 20%. However, the promoters may contribute more than 20%. There is no restriction regarding that particular point. But whatever is the promoter's contribution, as per SEBI guidelines, it must be locked in for a minimum period of 3 years. That means the entire promoter contribution is freezed. That means the promoters are not permitted to withdraw their investments before the expiry of 3 years. That means their contribution will be locked in for a period of 3 years, or their contribution will be freezed for a minimum period of 3 years. Only after the expiry of 3 years, the promoters are eligible to withdraw their money. Before the expiry of 3 years, the promoters are not permitted to withdraw their money or withdraw their contributions, because the SEBI, as per the SEBI guidelines, it must be freezed. Now, the promoters are supposed to bring entire amount of their subscription or entire amount of their contribution at least before 1 day before opening of the issues. Now suppose, let us discuss this particular point with an example. Suppose the company is going to offer its securities or its public offerings from 3rd May. Now, as per the SEBI guideline, it is compulsory for the promoter to bring his entire contribution at least 1 day before the opening up of the issue. Now, in this example, what was the date of opening of the issue? 3rd May. That means on 2nd May or before 2nd May, the promoters are supposed to bring their entire contribution in the company. That means it is compulsory for the promoters to bring their entire contribution in the company at least before 1 day from the date of opening up of the issues. Now the last guideline, which is concerned with entry norm 1 for unlisted companies, is the value of post-issue net worth size of the company should not exceed the value of its pre-issue net worth size by 5 times. That means the maximum value of post-issue net worth size should be 5 times the value of its pre-issue net worth size. Now let us discuss this particular concept with the help of an example. Suppose the pre-issue net worth size of a company was rupees 2 crore. Pre-issue net worth size was 2 crore. Now, according to this particular guideline, the post-issue net worth size should not exceed the value of its pre-issue net worth size by 5 times. That means 5 times of 2 crore is 10 crore. That means the company is permitted to offer a public offerings of a value of rupees 8 crore or less than 8 crore only, because when the company will offer public offerings of 8 crore, then the post-issue net worth size will become 10 crores. So in this particular condition, the company has to look after that the value of its post-issue net worth size is not exceeding 5 times the value of its pre-issue net worth size. Now, let us discuss regarding the SEBI norms for listed companies. Now, the listed companies are basically those kind of companies which are already listed over the stock markets. Some of the important SEBI norms, entry norm 1 related to listed companies are: point number 1, entry norm for listed companies also known as profitability route. Point number 2, suppose the company has changed its name within a span of 1 year, then at least 50% of the earnings must have been made by the company under its new name. This is also an essential requirement for listed companies under entry norm 1. Now, the third and last entry norm for the listed companies are: the value of the post-issue net worth size should not exceed the value of its pre-issue net worth size. We have already discussed this concept in detail. Now, let us discuss regarding the SEBI norms for unlisted companies, norm 2, because we have discussed regarding the norm 1. Now, under norm 2, this particular norm or entry norm is known as QIB route, that is qualified institutional buyers route. QIBs are basically those institutional bodies which have been permitted to subscribe the securities of the companies. They have been granted permission by SEBI itself. Now, the most important guideline under unlisted company entry norm 2 is the minimum amount of subscription that the QIBs must acquire in the total amount of public offerings made by the company is 75%. That means the QIBs must subscribe at least 75% of net offers to the public which have been made by the company. The same norm is stated under the listed category also. That means when we discuss regarding the SEBI guidelines for listed companies entry norm 2, here also we can say that the entry norm 2 is basically known as QIB route or qualified institutional buyers route. Now, the issue shall be made through by adopting book building method only. Now, here in this entry norm 2, when we will discuss regarding the listed companies, then the offer for the public issues must be made with book building method. That means the company can't adopt the fixed price method. It is compulsory for the company to adopt book building method. Now, the third and most important segment is at least 75% of the net offers to the public made by the listed companies in concerned with the public issues must be subscribed by the QIBs. So, at least 75% of the net offers must be subscribed by QIBs. Now, in the next video, I will be discussing with all of you regarding the SEBI guidelines for rights issue. Now, in that particular video, I will be discussing with all of you on 4 major key points. Point number 1, what are the different kinds of issues which are available before the companies? Point number 2, what are the meaning of rights issue or why rights issues are offered to the existing shareholders only? Now, point number 3, why rights issues are basically offered to existing and why they are not offered to any other investors. What are the SEBI guidelines regarding that particular point? And finally, we will discuss regarding the important guidelines which are given by SEBI related to the rights issues. So, thank you all for watching this video.